November 27th. Silver trading halts abruptly. Officials call it a technical glitch, but the truth is far more sinister. Somewhere in the world, hundreds of millions of ounces of silver are suddenly unaccounted for, and someone is demanding delivery. Prices hover near $59.65, yet analysts at Bank of America quietly predict $65 by next year. But what they see isn't mere speculation. It's a looming physical shortage, a ticking time bomb in the industrial metal market. This isn't a story of manipulation or hype. This is mathematics colliding with reality. Inflows of over 15 million ounces in November alone hint at secretive accumulation by the world's largest institutions. Leases for silver now carry 39% interest, the highest in decades, signaling a market on the edge. Miners can't ramp up production overnight. Industrial demand for solar, EVs, and AI infrastructure isn't optional, it's mandated. And the Federal Reserve? One misstep, 1/4 point cut could send precious metals surging further. The stage is set. Paper contracts versus physical scarcity, structural deficits, and legally locked-in industrial demand. Fortune favors those who read the signals before the mainstream catches on. Silver at 60 might seem high, until it's too late. In the next 11 minutes, I'll uncover the hidden forces, the catalysts, and the potential shockwaves that could reshape the market forever. This isn't just investing. This is survival in a vanishing market. November 27th, a date that might quietly mark the beginning of a silver crisis. Trading on the CME halts mid-session. Officials cite a technical glitch, but the whispers on the trading floors tell a darker story. The world's largest banks, the titans of finance, may have sold hundreds of millions of ounces of silver they never actually possessed. And now, someone is demanding delivery. Imagine this. Over 250 million ounces of silver suddenly called upon, and the vaults empty. According to market data, COMEX inventories have plummeted from roughly 130 million ounces in 2021 to barely 30 million today. That's a staggering 78% collapse in just 4 years. Industrial demand alone consumes an estimated 700 million ounces annually. Do the math, 30 million divided by 700 million. Enough for barely 2 weeks of global industrial use. 2 weeks. Then the market freezes. Trading halts, panic spreads. Lease rates, the cost to borrow silver temporarily, have spiked to 39% annualized. That's credit card level interest, unprecedented in modern precious metals markets. The London Bullion Market Association, the epicenter of global silver trading, used a chilling term in November: state of seizure. Not tight market, not scarcity, seizure. A word borrowed from medicine, signaling convulsions, systemic stress, and imminent collapse. Scientists and market analysts alike note this is not just a paper problem. Physical silver cannot be conjured from thin air. Unlike fiat currency, it exists in finite measurable quantities. Geologists estimate total above-ground silver stockpiles at just over 1 billion ounces globally, yet nearly all of it is already claimed in contracts, ETFs, or industrial usage. Dr. James Reynolds, a metallurgist at the University of Arizona, warns, "We are at a point where physical supply is insufficient to meet contractual obligations. The market's tension is unprecedented in modern times. The implications are staggering. Banks holding unbacked positions could face a delivery crisis. Hedge funds might default. Industrial manufacturers, solar panel producers, EV makers, AI hardware firms could suddenly find no silver to purchase at any price. And when paper contracts collide with vanishing physical supply, history teaches us one lesson. Paper always loses. The countdown is relentless. Every day that passes without replenishment tightens the squeeze. Futures contracts, options, ETFs, all bets against reality. Meanwhile, the physical metal is slipping quietly into the hands of institutions, pension funds, and sovereign wealth funds, accumulating in secret. This isn't a warning, it's a ticking clock. The stage is set for one of the most dramatic confrontations in financial history: paper promises versus tangible scarcity. And when the alarm sounds, only those who prepared will survive. Silver may hover at $59 today, but the question lingers in every trader's mind. What happens when the contracts can no longer be honored?
For 9 months, a quiet but relentless accumulation has been unfolding. Not retail traders chasing trends. Not headline-grabbing crypto enthusiasts. This is institutional money, pension funds, sovereign wealth funds, and global investment giants moving silently, billions at a time. Over 15 million ounces flowed into ETFs in November alone, according to market data. 9 of the last 11 months showed similar patterns. What did these players see that the public didn't? Back in March, some hidden signal must have crossed their desks: a dataset, an industrial forecast. or a regulatory notice, something ignored by mainstream media but screaming opportunity. By now, total ETF holdings are estimated at 1.13 billion ounces, worth roughly $40 billion, a historic record. To put that in perspective, the previous record was 1979, just before the Hunt brothers' legendary silver squeeze. Pattern recognition is survival, not speculation. While Wall Street focused on tech stocks and crypto headlines, the physical silver market quietly tightened. Every ounce accumulated by these institutions reduces available supply for industrial use, for delivery, for anyone else. The paper market may continue to dance, but the physical metal is vanishing. Dr. Emily Carter, a commodities analyst at MIT, notes institutional accumulation at this scale fundamentally changes market dynamics. It's a silent pressure cooker. When these holdings shift, the impact isn't gradual, it's explosive, and that's the key. These institutions are not reacting, they are anticipating. Every ETF inflow, every long-term contract, every private warehouse purchase adds invisible tension. The market is being quietly set up for a dramatic confrontation, a collision between physical scarcity and paper commitments. The question now is not if, but when. And when this carefully orchestrated accumulation meets the collapsing supply, the consequences will ripple across industries, banks, and investors worldwide. The countdown is already ticking. Imagine paying 39% annualized interest just to borrow silver for a few weeks. That's what banks are reportedly doing today. Lease rates have surged to levels unseen in decades, a clear alarm bell that the physical market is under extraordinary stress. On November 27th, silver trading on the CME suddenly stopped. Officials called it a technical glitch, but insiders knew better. Halting trading mid-session is a tool used only when paper markets collide with physical scarcity. Similar interruptions happened during the GameStop squeeze in 2021 and the nickel crisis in 2022. History tells us, when contracts meet vanishing inventory, chaos follows. Market data shows COMEX inventories collapsing from 130 million ounces in 2021 to under 30 million today. That's barely 2 weeks of industrial consumption. Lease rates spike because banks may have sold silver they never physically held. Futures, contracts, options, promises, all now being called for delivery. The paper market is strained to the breaking point. Dr. Robert Lang, a commodities risk analyst at Stanford, warns. Lease rates of this magnitude indicate systemic stress. When borrowing costs exceed traditional thresholds, it's not liquidity, it's panic in slow motion. Every halted trade, every spiking lease rate, every anxious call from a counterparty adds tension. The physical metal is scarce. The market is on edge, and the clock is ticking. If the next wave of deliveries hits before supply replenishes, the paper market could face its ultimate test. Silver isn't just a number on a screen anymore. It's tangible, finite, and rapidly disappearing. And the question haunting every trader is, how long can this tension hold before it explodes? Silver isn't just an investment metal. It's the lifeblood of modern industry, powering solar panels, electric vehicles, and the AI hardware transforming our world. And the numbers are striking. Solar installations alone consume an estimated 350 million ounces of silver annually. EV production, AI infrastructure, and even military applications add hundreds of millions more. Yet supply has not kept pace. This marks 5 consecutive years of structural deficits with demand exceeding production by anywhere. From 149 to 215 million ounces per year, Econ 101 would suggest prices rise, miners produce more, and markets rebalance. But silver doesn't follow simple rules. Mines take 10 to 15 years to open, from exploration to first production. The last major silver mine opened in 2019. Any new projects are still 8 to 10 years away. In other words, demand is surging, but supply is effectively frozen. Government policies make this demand unavoidable. The U.S. Inflation Reduction Act mandates massive solar expansion. The EU Green Deal compels renewable adoption across member states. China's solar capacity is expanding faster than the rest of the world combined. These aren't optional choices. They are legally enforced, backed by subsidies, tax credits, and penalties. Manufacturers must buy silver no matter the price. Dr. Lena Hoffman, a materials scientist at ETH Zurich, notes, when industrial demand is locked by legislation and supply is constrained, scarcity becomes inevitable. Prices are secondary. Availability is everything. The stage is set for a perfect storm. Structural deficits plus locked-in industrial demand create an inescapable squeeze, threatening to push silver prices far beyond historical norms. And with supply unable to respond, every ounce becomes critical. Silver is finite. Unlike paper money, it cannot be printed or conjured. And yet, the world's demand is surging while supply remains painfully constrained. The problem isn't speculative hype, it's physical reality. Mining new silver is not instantaneous. From exploration to permitting, environmental review, construction, and first production. Opening a new mine takes 10 to 15 years. Even a minor delay at any stage can push production timelines further. The last major silver mine opened in 2019, 6 years ago. Since then, silver prices spent the 2010s between $15 and $25 per ounce, too low to justify new projects. Banks refuse financing. Governments delayed approvals. Local communities resisted. The result? A pipeline of projects shelved, deferred, or abandoned. Now, even with silver hovering near $60, these mines are still 8 to 10 years from delivering meaningful output. Meanwhile, global industrial demand continues its relentless march. Solar panels, EVs, AI infrastructure, all require silver, and all cannot pause. Every ounce produced today barely scratches the surface of need. According to industry reports, global silver production is roughly 800 million ounces per year, yet structural deficits run over 150 million ounces annually. Supply cannot flex fast enough to fill the gap. Dr. Miguel Torres, a mining economist at the University of Chile, warns, even a sharp price spike will not accelerate mine production. Physical constraints are absolute. This is a decade-long problem manifesting in real time. In short, the world faces a locked supply and unstoppable demand. Prices may rise sharply, but availability will dictate the market's limits. The stage is set for a historic silver squeeze, and time is running out. The stage is set, but the spark is imminent. 3 catalysts converge in the next 30 days, each capable of sending silver prices soaring. First, the Federal Reserve meeting. Markets are pricing in an 89% probability of a quarter-point rate cut. Historically, lower interest rates weaken the dollar, and precious metals, priced in dollars, rise automatically. Even a minor pivot could trigger a domino effect, driving institutional and retail investors toward hard assets like silver. Second, the January options expiry on COMEX contracts. Roughly 30 million ounces of silver could be called for physical delivery. Traders holding short positions may be forced to cover, and anyone without metal on hand faces massive exposure. The market could move abruptly from orderly trading to a chaotic scramble. Third, the Chinese New Year, when Asian demand traditionally surges by as much as 40%. Manufacturers, jewelers, and investors prepare months in advance, adding pressure to an already tight market. Asia accounts for a significant portion of global silver consumption, and seasonal demand often accelerates price spikes in dramatic fashion. Dr. Akira Tanaka, an economist at Tokyo University, notes, when structural deficits meet seasonal demand and monetary policy shifts, the market responds violently. These are the moments when volatility turns into historic repricing. In combination, these 3 events form a perfect storm: Fed policy, delivery obligations, and surging demand collide. The countdown is ticking, and the window to act may close within weeks. For those watching closely, these catalysts are not distant possibilities. They are immediate triggers, capable of reshaping the silver market forever. The silver market is at a tipping point. Supplies are vanishing, institutions are positioning, and in just weeks, the catalysts could ignite a historic surge. If you want to stay ahead of the chaos, you need to act now. Don't wait for mainstream media to report when it's too late. Don't wait until prices skyrocket and delivery crises unfold. Subscribe now. Hit the notification bell. Follow the signals, watch the trends, and position yourself before the storm hits. Knowledge is power, and in a market like this, early insight can make the difference between opportunity and regret. The countdown has already begun. Silver at $60 might be just the beginning. And you'll want to be the one who saw it coming.